You're a fun person to do lives with. Hey, everybody. It's Tuesday night, and here we are.
We're back.
We are back, Jack. Everybody else jump on and tell us.
Hi, Jack.
Yeah, we are back. It's Tuesday, and we have internet, so that alone is a good reason for us to be on, because what was it, 2 weeks ago, internet went down. We couldn't do a thing. So, hey, everybody, though. Good to see you guys. Yeah. Interesting topic today that we're going to talk about, a little bit different.
We're talking about arms.
Yeah, arms. Just not those kind of arms. In fact, I was wondering, like, how many people that are viewing, do you even know what we're talking about? Like,
do you know what an arm is?
Do you know what an arm
I have
is?
two.
Yes. Okay. Yes. Aren't you? You just take over. You got the good stuff going here. All right. Questions, guys. We've got some good questions here. Do you even know what an ARM mortgage is?
Okay,
and if so,
let's jump in.
Go ahead.
Would you ever consider an ARM mortgage?
Yeah. Yep. All right. So let's hear from you guys. In fact, nobody has said hello yet. Come on, jump in. Where is everybody? Come in and say hello. Okay, there we go. We've got our first one.
I don't know. You don't know? Okay. That's good. That's good.
That is a great one.
We'll talk about it.
Yay. Okay. And then, how do y'all adjustable rate mortgage? That is exactly right. It's an adjustable rate mortgage. And I can tell you what it's not. It is not a rate buy down.
True.
Completely different animal. And yet these are making
the costs are different.
Definitely. Yeah. It's completely different than a rate buy down, completely different than a fixed rate mortgage, but the ARMs are making a comeback. They're really hitting strong in the market. And I think I think we need to talk about it because
they were real big in the before 2010 time frame.
Oh, they for sure were. They were
a little bit crazy back then.
They really were. Now they're fully amortizing ARMs, is my understanding. Back then, you had negative amortizing ARMs, you had interest-only ARMs. To be honest, guys, that we bought our house we're in right now with an interest-only ARM. And it adjusted, I think we had it for like 10 years, and it adjusted back and forth. Like, I think there was a difference of like $500 a month sometimes, the way it adjusted. So we're very familiar with the way ARMs work. We have. All right, let's see here now. Hello, Wendy and Dale. It's always good to see you both.
Hey, Isaac.
Good to see you too. I am so glad you're here. Okay, so would you ever consider an ARM mortgage? First choice is yes, if the numbers make sense. So what do you guys think? Are you comfortable with if the numbers make sense? Are you open to considering it? The second one is maybe, but I'm cautious. Okay.
Should be cautious.
It's a good thing. You should be cautious. No, too risky. I think that's fair as well.
May or may not be.
May or may not be. Or D, not sure. I need more info. So chime in, you guys. What do you think about adjustable rate mortgages? Let's hear what your thoughts are. Either yes, if the numbers make sense. Are you willing to consider it? Maybe, but you're cautious, which you should be. I think B is a good one.
Cautious is good, but info is good to help you learn if you need to, how much caution you need. So, I mean,
I personally think there are times that adjustable rate mortgages make sense.
Probably a lot of new buyers nowadays, since the age of newer buyers have really decreased quite a bit, that don't really know what ARMs are, because, I mean, it was a big deal in the early 2000s, even before then. And then they kind of went away after the 2008, 2010 craziness. And they never went away. They just weren't used as much. And
well, when you have fixed rates at 3%.
Well, then you had all of the government funding stuff in the 2020 through 23 time frame and stuff that caused the crazy rate time. And then there's probably a lot of people just really don't understand what an ARM is. So they haven't had to use them.
That's what I was going to say. That didn't matter. Like, if you could get a fixed rate at 3% or 2.5%, why would you even care about an adjustable rate mortgage? But now people care. A key thing for you guys to know about the ARMs, which you may not know, is that you get a lower starting rate because you're sharing the risk with the lender. And that means you benefit if rates come down. All right.
So let's start from the beginning. So an ARM, like like Oliver's and Chill.
Oh no. Okay. Yeah.
Yeah.
There we go.
So it's an adjustable
rate
mortgage.
mortgage. Yes.
So your rate is going to adjust.
Mm-hmm.
However, there is a point where it is fixed.
Mm-hmm.
It's either a 3, 5, or a 7.
Mm-hmm.
So you'll get a lower rate for either 3 years, 5 years, or 7 years.
Mm-hmm. Mm-hmm.
7 years are pretty awesome.
Yeah.
Like I've seen those of recent with even builders and stuff. So some pretty good deals. So you'll get, and the idea is that you get that you're getting a lower rate with the risk of at the point when it's becomes adjustable, it's going to adjust with a specific index. An index is what they base the rate on. So it could be, there are several different things they base them on. Is like a lot of times it's a treasury, there's a LIBOR rate, there are different rates that they're basing. And then in that mortgage, also in the terms that you're getting, they're basing a margin of how much that rate is, and then how much you're paying above that. So, and then they're setting how often it adjusts. Usually it's either 6 months or a year. Most of the time it's about 6 months. So.
Yeah. The key thing is, because you're sharing the risk with the lender, it can go up or down. People tend to think, oh, my payment's just going to go up, but that's not necessarily the case. Like I said, when we had an interest only arm on our house when we bought it, and the payment just came crashing down. It was crazy. Every 6 months we'd be like, whoa, our payment just dropped. Our payment just dropped. Our payment, because you're sharing the risk. That's why we stayed with it
so long. Yeah.
Yeah. That's why we didn't refinance, because we were like, this is awesome, man. Our payment keeps going down. So it is about sharing the risk.
So even if you go with like a typical 30-year fixed rate, the rates still change, and the lender still has to deal with that. The lender, with the money that the funds that they're giving you, they're dealing with those changes and that margin. So in this case, as an arm, you're actually kind of dealing with it with them.
Mm-hmm. I mean, if you think about it, with the fixed rate mortgage, if the rates go up, too bad for the lender. If the rates go down, too good for the lender. Like the lender absorbs all the risk of the mortgage, of the rate changing, the underlying rate changing. And that's why the margin's higher. That's why fixed rate is higher than ARMs, because the lender's absorbing all the risk, versus with an ARM, you're accepting some of that risk. And it can be a benefit, or it can be really bad, or it can be really good. Mr. OL, hey, how are you?
Good to see you again.
It is. And C for me, too risky. They do. And he has a good point here. He says, weren't ARMs part of the reason for the 2008 housing crash? There is some truth to that.
They weren't regulated very well, and it was
Well, there were a
lot of things.
A lot of it was qualifying, that the buyers weren't qualified.
The buyers weren't qualified.
Yeah, and if you think about it, qualification is hard, right? Because with the ARMs, you've got to figure out, you've got some adjusting there. And then the other thing with the 2008 is that it was the negative amortization ARMs that were so bad, the option ARMs, those were the ones that really caused the tank. So. And we're not seeing those either. These are just traditional ARMs. Let's see. Okay, Oliver says C, too risky. Then we got 2 saying too risky. Okay, and then Ramirez says D for me, but is the ARM meant to have in goal refinancing? Are you buying it specifically with the goal of refinancing? Possibly, but also I'll tell you who it's a good fit for is somebody who's in college or seminary, law school, and they know they are not going to be in that house for more than a couple years. They know they're going to be moving. All right. So why would you pay for 30 years of a fixed rate when you can pay for 5 years of a fixed rate and have a lower payment? So if you know that you're going to be moving.
The question is, how long do you think you're going to be in your home? So there are 3, 5, and 7 year. If you can get a 7-year ARM, and maybe, how many people live in a home longer than 7 years? So,
but it is a risk. You guys that are saying, see, it's too risky, you are absorbing this. That's the whole reason why they're cheaper, is because you're sharing risk with the lender.
Yeah. The first number in the ARM, there isn't any risk.
Very true. Very true.
So again, it just depends on how long you're going to be in the home. So.
Yeah, that's a good point. When I was saying that we had an ARM, ours was interest only for 10 years, adjusting every 6 months. That's a pretty high risk.
Yeah. So there is a little bit of risk, even if during that time, because you do have to, if you're going to move out, either you're going to sell. Well, okay, if you sell, there's not a risk. If you stay longer and you refinance, then there's cost for that. So, and that
That's
depends
a very good point.
on the mortgage company you refinance with.
That's
and some
excellent point.
Nowadays, there's a lot more mortgage companies offering free refinancing if you stay with them. So.
You make an excellent point, because you have to think about the fact that if I'm going into this ARM with the sole plan to refinance, why are you doing the ARM? Because you're going to have a lower interest rate, but then it's going to cost money to refinance. And now granted, the refinance hopefully will be wrapped into the loan, so it won't be like a, in a physical,
you can do that. So.
But still, ultimately, so don't go into it, I think, necessarily planning immediately to refinance, unless, like you said, if you've already got a deal to where you can do it for less. Mr. OL says fixed rate is a safer bet. It absolutely is a safer bet. You are not sharing. You are not taking on the risk. You are making the lender take the risk. Okay. C. Isaac also says C, which is no too risky. Okay. Hey guys, my brother. Hey, Oliver's and Chill.
7/6.
As 7, that means it's fixed for 7 years and rotates or adjusts every 6
months.
months.
Every 6 months, probably. Mm-hmm. Yeah, okay, makes sense.
On his house he bought in June. Do you think that was a wise move? So there's just it really depends on his long-term plans for the house. Like if he knows he's not going to live there for longer than 7 years,
that was excellent. Yeah.
Then that's an excellent deal, because I think that the question to ask is like, do I want to pay for 30 years of fixed if I'm really not going to live here for 30 years of fixed?
Yeah.
Right. But it is a risk, right?
How many people live for longer than 10 years in a home?
That's true. That is true. But at the same time, you've got to think about the fact that if you move and suddenly rates are now much higher, then you have to pay for that new high rate. So the long short of it is either you're taking on some of that risk, or the lender's taking all the risk, and that's the difference. And again, this is completely different than rate buy downs.
A lot of it
not
has
the same
to do
at
with
all.
Planning ahead. So
But there are times that it makes sense, but it's not your safer move necessarily. But there are times that it makes sense. All right, let's take a look at our next one. Okay, here's a good one. What would make you choose an ARM over a fixed rate? Assuming there would be something. All right. Lower upfront payment. Okay, it will absolutely have a lower upfront payment. A shorter time horizon in the home. So if you knew that you weren't going to be there for long, if you believe rates will drop, because remember, you're sharing the risk. So if rates are going to come down, you're going to benefit from that with an ARM. Builder incentives, they're more likely to pay for rate buy down, but they do give money.
There have been I've seen a few ARMs with builders.
Have you?
Not many, but yeah.
Or nothing, I want fixed. Okay. So which is going to be some of our people already, I know. So what do you guys think? What would make you choose an ARM over a fixed rate? Lower upfront payment, shorter time horizon. Again, if you're in college or law school or seminary.
Maybe even the military.
That's a great point. Could be military.
Or some jobs.
Or any kind of school that you're not going to be staying there. Builder incentives. To me, the builder incentives that, I'm like, I want a forward commitment,
Could be, maybe it's a step home.
Yeah. Or nothing, I just want fixed. All right, let's see some questions here. What would be the best ARM scenario for a home buyer within the actual market in Dallas? You know what? We are thinking human beings who strategize, right? And so you've got to evaluate your situation.
Yeah.
How long are you going to be in that home? Right.
Why are you if you're moving to Dallas, why are you buying a new home? And stuff?
Right. Yeah.
What's the plan for that new home? It's probably a good chance rates are going to come down.
I think so.
Late spring, early summer. We don't know for sure. We know I am almost, I would say, high 90% plus percent sure that prices are going to go up as of January.
Yeah, I kind of am feeling that as well, just because of the rates.
But the rates, so we'll see.
Oh, you guys, you want to know something? I think this is really important is, you know how we're always talking about how the fixed rate mortgage is more tied to the 10-year treasury yield? That's not the case with the ARMs.
Oh, yeah, that's true.
the arms are not tied as much to the 10-year. They're different. They are attached more to the short term because, again, they're sharing the risk with the lender. So that is a different thing as well. So in terms of what would be the best ARM scenario, your safest bet.
If the Fed is dropping rates, then that's more affects what the ARMs are doing.
Right, right. You get to benefit with an ARM. You get to benefit when the rates go down. Best ARM scenario is going to depend on how long you need that thing fixed for. Right. And so you're going to get your rate is going to be based on how much risk you're willing to share with the lender. All right, let's see here now. Mr. OL, with a 30-year commitment to a fixed rate, you always have the option to refi when the rates drop. Absolutely, you do. You absolutely do.
It costs to refi, but
does
yes,
cost.
you do. Actually, depending on how you buy and how you set up your first mortgage, there definitely are some lenders that will pay within a certain amount of time. They will give you a free refi. Usually it's about 3 years, 3 to 5 years.
Very true.
So like that.
And Ms. Roa says because I'm looking for a forever home, so I'm thinking long term. I think that's a great reason too. Yeah, if you're looking for long term forever home. Yeah. Let's take a look at our article. What do you say? What do you think? Maybe take a look at our article. Let's make this a little bit bigger. There we go. And take Mr. OL off. There we go. ARMs make it more tempting with Fed's recent rate cut. Now, just the title alone.
Actually, I'd say from the tempting thing, maybe it should be make it more choices.
Yeah.
I mean, it's good to have choices. So.
But remember what I just said, that the ARMs are more impacted by the Fed's rate cuts than the 30-year fixed. Okay, so you see a little bit more of a correlation there. Okay, let's see what we have here. All right. For the second time in a row, this one is October 31st is when this was written. For the second time in a row, the Federal Reserve this week cut its benchmark interest rates by 25 basis points, and homebuyers are watching closely to see how this may affect mortgage rates. So far, the results are favorable. The 30-year fixed rate mortgage averaged 6.17% this week, marking the fourth consecutive week of decreases. But it's important to note that the Fed's rate, and this is very true, the interest rate that banks borrow and lend to each other does not directly set mortgage rates. And I think we kind of hammer that home nearly every week. We talk about that a lot, though it can influence them. We're always pointing that out. Okay, the Fed has an impact, has an influence. It doesn't directly, it's not a direct influence. Markets widely anticipated the Fed's move, and much of its impact was already priced in, meaning mortgage rates had moved lower ahead of the announcement, said Bill Banfield. Plus, with projections pointing to another potential rate cut by the Fed before the end of the year, mortgage rates are already sitting at their lowest average of 2025. Okay, your prediction. Are they going to lower in December? Because now I'm not so sure. I went from they were thinking close to 70% it was going to, and now they're thinking in 40% maybe. Yeah. So it's hard to say. I mean, there are a lot of things up in the air, and it's just I think when the labor comes out, is that on Thursday? That's going to tell us a lot. Yeah.
Because of the government shutdown, we've had a lot of things we didn't know, and if the labor comes back the way we expect it to be, a lot lower, so a lot weaker, so then that would probably help. I think the inflation numbers are a little bit skewed also, because there's a lot of temporary things that are causing prices to go up. There's not really long-term, real, true inflation. So, and that's hard to say. So it depends on how they look at that. So.
Humphrey says, I think the lower the economy is very tight. I think if they get, if they get what I'm thinking they're going to get with the labor market, I think they're going to lower. Yeah. I just am just seeing what we're seeing with the labor market. Yeah. All right, let's see. Back to the article. So we talked about that. Mortgage rates generally track Treasury yields, and we talked about that. But loans like ARMs and home equity lines of credit may see a more direct impact from the Fed's latest moves. So if we get frustrated by mortgage rates not going down like we want them to, and they're not doing even when the Fed lowers, with an ARM you get more. It's more impactful. Yeah. You get more of an impact there because they're more directly influenced. And again, it has to do with sharing risk. It's a shorter margin and a shorter margin and sharing the risk. So All right, let's see here now. Recently, more home buyers are turning to ARMs. In September, ARMs made up about 10% of all mortgage applications, the highest level in nearly 2 years, according to the Mortgage Bankers Association. These loans offer lower initial rates than fixed rate mortgages for a set period, usually between 5 to 10 years, before resetting based on market interest rates. And again, keep in mind, this is not the same as a rate buy down. This is very different. Buyers are seeing savings and taking advantage. A 5/1 ARM, for example, averaged 5.66% in September, nearly a full percentage point below the 30-year fixed average. Remember, when we hear that, a 1% may not sound like it's much of a difference. It actually is a pretty big difference. It really does.
It's the same thing as taking 11% off the sales price. So
yeah. And so you hear 1%, that's actually a pretty big deal. Okay, and so here's where we are today on our 7/6 ARM mortgage rates. You could get a 5.5% on the MBA. So you can definitely get down there in the fives with an ARM. All right, let's see here now. Back to the article. Here we are. On a $400,000 loan, that could translate to about $200 less per month in savings. So that 1 point difference, that's a pretty big difference. There's certainly a lot more interest in adjustable rate mortgages as people look for anything that can drive down the initial cost of buying a home, says Matt Schultz, Chief Consumer Finance Analyst at LendingTree. Depending on your circumstances, it can be a good choice. And I think that's really fair. I think, yeah. And I think as much as I'm typically like, okay, you need to be careful, make sure this is a calculated decision. Still, if you know that you're selling and moving out of state because you're going to get relocated for whatever reason, then in that case, I'm kind of like, it doesn't necessarily make sense to pay for 30 years.
Yeah.
So much it depends on your specific situation. But I do think that, like who was it that said earlier, I think that they really got a bad rap in 2008.
Oh, yeah.
And so that has caused a lot of people to evaluate. And
there were a lot of sketchy loans.
There were.
There were a lot of other sketchy loans going on. So.
Yeah. But it is definitely true that the whole point of the ARM is that you are absorbing more risk. And so you have to make a calculated decision with that. All right, let's see, where were we? But you need to understand what some of the potential risks are. When the rate adjusts, it could go higher, making the mortgage payment more challenging. Don't go in naive, talk to a lender first, he says. Absolutely. I completely agree that is 100%. It's got to be an informed decision. Even for those preferring fixed rates, opportunities exist. The average 30-year fixed mortgage has dipped to its lowest level of the year. The last few months have brought lower rates, and homebuyers are increasingly entering the market, says Sam Cater, Freddie Mac's chief economist. Mortgage applications for home purchases, a gauge of future buying activity, climbed 5% last week and are now 20% higher than a year ago, according to MBA data. And we do need to talk about that, guys, because we're always committed to being honest with you. And in all honesty, what we've seen is a much more active market right now.
It is.
We saw amazing. A slow summer with a lot less demand, and it was very surprising. We're like, what is going on? This is summer. Where's everybody? Just was slower. And now all of a sudden it's like just the mortgage rates coming down by 1 point, which we always predicted. When rates come down rate sensitive. But again, we're just going to be honest with you guys, right? Right now, we are seeing a lot more buyers enter the market. The most demand correlation we've seen is when we talk about the highly liquid price range paired with good schools. So in other words, if we're looking at an A school and a price of $350,000, those are going really fast.
Yeah.
Yeah, and you might think, well, duh, of course they will.
500,
but
I would say, yeah.
And you might think like, well, duh, of course they will. But I'm telling you, this summer they weren't. This summer they were not moving.
Wasn't much of anything moving in this summer.
Yeah. This summer it was much slower, and all of a sudden it's really picked up. Which I tell you what, I'm really interested to see. Typically, right after Thanksgiving is when everything stalls out.
Oh, yeah.
Nobody wants to move. So I'm like, is that going to happen? Because like so far, like October and November have been very, very lots of strong demand. And in fact, honestly, like you can mark our words because I think we're going to see it in the data. It's going to be a lagging indicator because we're going to have to see closed sales. But I think we're going to see a pop up in October and in November due to as many more.
Yeah.
And we've seen it in the sellers they adapt quickly, especially the builders saying, no, we're going to raise our prices. We're not going to come down in price. We're seeing, I don't necessarily like it because we tend to work with a lot of buyers, but nonetheless.
Yeah. I mean, even just even pre-owned sellers have been like, well, I'm just going to wait and see. I'm just I don't want to drop down my price.
So I'm hoping after Thanksgiving, the dreary of the month, we'll see things slow down a little bit. I am hoping. Okay, so I'd want to see the terms of the ARM: floors, ceilings, maximum period adjustment. The cool thing is, Humphrey, is that there's no surprise there as to exactly when it's going to change. It is written out, and even how much it can change with each adjustment, it is all going to be in the mortgage. The terms of the mortgage are so much longer with an ARM. Like just the deed of trust. The deed of trust is going to have so much more. And I'm telling you, everything's spelled out. It's going to tell how often it adjusts, how long it's fixed, how much it can adjust at each period, what the margin is, what the index is, and also the lifetime maximum.
What it's based on.
Yeah. So you're going to get all of those answers well up front, which is good. I mean, I think that's nice if you can go that route. Okay. What would you do if after the 3, 5, or 7 year fixed interest, your new ARM rate goes up dramatically and you plan on staying a few more years in your home?
Refinance.
That is a great question. That is a great question. You've got to calculate your risk. And saying you share the risk with the lender, that's the risk. However, you have to keep in mind that each adjustment period has a cap. And so it cannot go up by a huge amount. It can only go up a certain amount at each adjustment period.
I would say, in general, if it's an ARM or even rate buy downs or anything, when you have a savings like that, you should take the extra money and put it in savings in case of things that are going to happen like this, in case of rate increases, in case of having to buy, having to move, anything like that. That's use that blessing of lower payments to save.
Yeah, absolutely.
For those
fiscal
things,
responsibility, guys. Keep it in savings. Absolutely. If you're going to save, if you're going to have a lower payment, I always encourage our buyers. Like I am weird this way. I'm always like, let's spend as little as possible to get you what you love.
Yeah.
And they're like, wait, that means you're going to get paid less than a commission. I'm like, I know, but this is about you, not me. Let's get you in for the lowest.
Figure out what's best for you guys. So
let's get you into the lowest price that you can, so you can always be still putting money in savings. So what would you do if your ARM rate goes up dramatically? First, have money in savings. Second, know that it's going to be capped, and so you can always be prepared. So it's not going to go up by a huge amount.
The exact terms, so you know where it's going to be.
Like when we did, now, would I do an interest only ARM again like we did? We wouldn't, but back then we didn't know any better. We weren't licensed yet. Didn't know real estate so much.
I haven't seen any of those advertising ones.
But our margin was so low, it was literally index plus 1/2 of a point.
Yeah.
And so like when rates dropped to 3%, we instantly had a 3.5%, so it was, we actually ended up saving so much money, but it was a lot of risk. It absolutely was. Okay, let's see. We already did that one. So let's go ahead and jump back into our article. Which by the way, guys, if you have questions, please leave them in the chat. Love to talk to you about new construction, about locations, geography, new construction, builders, all of that good stuff. So please leave your questions. All right, the last few months have brought lower rates and home buyers are increasingly entering the market, says Sam Cater. Did I already read that one? Okay, let's go on to the next one. The National Association of Realtors recently reported a 4.1% annual increase in existing home sales for September, showing some renewed buyer activity. And I would say that's what we've seen as well. That's been just on a micro, level of our brokerage. We've just been a lot busier. Okay, mortgage rates. Mortgage rate drops from above 7% at the start of the year to the mid 6% range in July. Already we're producing tangible savings to home shoppers. A lending tree analysis found buyers saved an average of $40,000 over the life of a 30-year loan, or about $112 a month from that time period alone. And I think that explains, again, Dallas is so rate sensitive. I think that's where we're seeing so many more people enter the market. Further declines recently in rates suggest even greater savings.
Of course.
All right, fixed rate mortgage. We included just a few facts here, not trying to make it like a tutorial, but just a couple things here. Interest rate with fixed rate is fixed throughout the life. Okay, it's predictable. Okay, but you're going to pay for it, that predictability. Okay.
So with a higher rate.
Right. Yeah. You probably didn't think about that, but with a fixed rate mortgage, you are paying for that security with a higher rate. Okay, so you're paying for predictability.
Even if rates go down, if you get an ARM, you're going to get an even lower rate.
Yes.
True.
Yeah, exactly. So if interest rates go up, you don't change. If interest rates go down, it doesn't change, but you can always refinance. And so here's our comparison to the ARMs. Interest rate can change periodically. Buyer shares the risk. How soon it will change is spelled out in the mortgage. Okay, so there's no mystery. Fixed period of time when mortgage will not change, right? So here's your introductory. That's your first number. Right. So if you hear like
3,
a 5,
7,
1
or
ARM,
10,
right, that's your fixed rate period. After that fixed period of time, the interest rate will go up, down, or stay the same. How often it adjusts will be part of the mortgage as well. It might adjust every 6 months. It might adjust every year. Common adjustable rate mortgages 3-1, 5-1, 7-1. Just as an example, I think you talked about this before. A 7-1 mortgage is going to be fixed for 7 years, and after that, it will begin to adjust. Okay, so the bank is going to give you a lower rate if you're willing to share the risk, and it's also going to be more impacted by federal movement
once it comes to the adjustment time.
Yeah, absolutely. So that was our article for the ARMs. I hope that was helpful and interesting. I know as I was reading it, it was a refresher. And keep in mind here, what we didn't talk about were rate buy downs and forward commitments. Care to explain the difference?
So forward commitment, it's pretty much only going to come from a builder because that's a lot of money. So usually a builder will take several $1 million and they're going to pay up front to their preferred lender and say, okay, there's this many millions of dollars, however many homes or transactions you can get them down to a certain rate of 4.99. Usually that's pretty much the average. I've seen some at 5.99, but usually it's like 4.99. So that rate, because it costs money to go from whatever the market rate is at the time, 6.5 or whatever it is, down to the 4.99. So they're paying that up front. It's already paid for. It's not in your concessions. It's not in the sales price.
Right.
It's nothing. It's already done. And so that lender, so when you buy that home, you're getting a 30 years fixed rate at that whatever rate they paid for. So until that money is gone. Buy down is you're paying for that. There's a cost to buy it down from that, say if it's the 6.5%, whatever it is, down to whatever rate you want it to be at, or what they're offering you to pay it down to for. Could be a 2. It could be a 1-1 where you're just buying for 1 year. It could be a 2-1 buying for 2 years. It could be whatever. So whatever. So it's only a rate buy down for so many years. 1, 2, 3, something like that. So, and sometimes it's a 3-2-1, and then it steps up. But at that last one, whatever that one is, that third year, whatever it is, second or third year, then the rate goes up to whatever the market rate is at the time. So,
and then it stays the same.
It stays the same.
Doesn't
then
adjust
it's fixed
again.
at that point. So.
Right. It doesn't.
So it's
adjust
just
again.
a temporary thing, just to kind of get you in. Hopefully, you're saving money during that time. Hopefully, or you're only going to be there that long, and you're going to sell it, or you're going to refinance. Maybe that's why you hear the whole the statement, date the rate. Marry the home.
Marry the home, date the rate. Yeah.
And so you're basically hoping that rates are going to be down enough that you can refinance in between that time frame and get to maybe not as low as your rate buy down, but at least lower is more affordable. So
you know what? And if you don't know how long you're going to be in the home, go with the fixed rate. Right. What I was going to say about the rate buy down is essentially it's a piggy bank.
Yeah.
Because you're like, okay, at 7%, if my mortgage payment is $4,000 a month. At 5%, if it's $3,000 a month, basically they're just putting that money. That's how much they're paying.
$12,000 annually. Save that and then use it for a refinance, leave it for whatever. Yeah.
But also that's what the seller is paying.
Yeah.
So it's really a 30-year fixed rate mortgage,
Oh,
and they're
right,
just
I see,
paying it
yeah.
down. So this is like a piggy bank that
Yeah.
the seller's saying, here, put all this in a piggy bank and pay for the buyer to have the lower payments for this amount of time.
And that's what you can see. So when you're like, if you're buying pre-owned, or if you're even negotiating with a builder and you can't get prices down or something, see if you can get concessions, and then talk to that lender and run some scenarios and see if you can get a lower rate for at least a little bit of time,
get what you can.
just to get, to save some money, so.
Forward commitment, absolutely nothing to do with the buyer.
Yeah.
Nothing to do with the buyer. Forward commitment, it happens well
Paid
before
up
the buyer.
front, yeah.
It happens before the buyer ever comes on the scene. It has nothing to do with IPC limits, anything. Rate buy down has to do with the buyer.
And you may have noticed that of recent, I'll tell you, within even the month or two recent, there's not any forward commitments now, because they're expecting rates to come down starting next year, and prices are going to go up. So the builders are already raising prices in January. So
I actually made a video about that like 2 months ago, where I said, expect forward commitments to be the first to go when mortgage rates come down. And sure enough, that's exactly what's happened, is they don't have to offer them as much. All right, Purple Drink. Hey,
you can go back and watch it again.
Yeah, just go back. We just won't be live anymore. I'll be exploring new homes in Salina tomorrow morning, and that's fun. What communities besides Legacy Hills would you recommend me to visit? I'm just in the exploration phase. Do you have time for a coffee? He's like, coffee drinker, not me. I don't even know that I would necessarily recommend Legacy Hills. Of course, part of it depends on your price range.
Yeah, price range and what you're looking for. I mean, Legacy Hills is big. There's a lot of choices for builders. That's for sure. I mean, eventually it'll be a nice area. It's a lot of lower. It's a lot of lower priced builders in one place. They will eventually get the higher ones in there, but
do you think they will? I hope so.
They said they were. I mean,
because there's just so many of these really low budget builders.
They just barely even touched the size of what is going to be in it. So
it's huge. It is huge.
There's so many places in Salina. I mean, what do you
tell us your budget? That will help us a lot in answering your question.
I mean, or you could look down in our information on the YouTube channel, and you can send us a we have a Let's Find Home questionnaire, and that's how we always get acquainted. That's how we always start everything, and then we're real proactive in helping you with the search. If you're like in the 400,000 range, you're looking in Legacy, there are other places that you can do better for 400,000. You might want to explore North Sky. I really like North Sky. North Sky is nice. They have kind of a mix of builders there, so not near as large as
It's not. That is true. Okay. So he said, oh, wait, let me show this one. Budget of $500K, full of faith. Yeah. So you can do North Sky. For sure. And Humphrey also says Painted Tree, and that is true. The cool thing about Painted Tree and McKinney is you don't have a pit or a mud, and that just makes such a big difference.
Actually, that's the other question I was going to. Why are you picking Salina? So
but I agree with you. Purple Drink, North Sky. I like North Sky a lot for that 400 and 500 because you're surrounded by Perry Homes and American Legend. I mean, I'm just you've got good, strong builders, and you've still got. You can get the 400 and the 500, and I just think that diversity also
there's a lot of schools right there too. If you have children, they have new schools up there right
All right, Purple Drink is also recommending 10 Mile Creek. Not bad. Yep, some good options. Okay.
10 Mile Creek should be close to done though. I have to look at it. It's been a little bit because of 10 Mile Creek. But.
All right. Well, unless there's any other questions. All right, let's see here. Yep, Cambridge Crossing. Cambridge Crossing is nice as well. What do you think about Cambridge? I love the entrance to Cambridge. That's my favorite thing. It is so majestic. I just love it.
I have to look who's building. I know a lot of what's left is more on the south end, and that was where they were doing the smaller lots. Perry was pretty close to being done. That's who we mostly talk to in Cambridge. Yeah, it isn't nice. They do have some really nice amenities there in Cambridge Crossing.
They do.
It's over on the side well, okay, if you're gonna go, you go north and then over like what's the main road? It's a weird name. Anyway, but
yeah.
I mean, yeah, that side,
it is a lot.
That side of Salina has a little bit of traffic issues because they haven't updated the roads over on that side. But Cambridge Carthage is not so bad because it's still.
And you know what I was going to tell you also, let's see here now, is that I made a video all about Salina homes under 400,000 that you might want to check out, even though you're like looking in like the 500,000 range. That might give you some good ideas as well, for other communities to look at. There is a lot you can get. There are plenty of choices in Salina in that 500 range. A lot of choices.
Also, depending on like home size and lot size too, because there's also uptown Salina too that will have some in that range as well. So yeah. If you like being like closer to the city, all the stuff.
Wilson Creek isn't bad either, right across from 10 Mile Creek.
Yeah.
Both
of those are almost done right. I just drove by Wilson Creek today, so.
You were up in Prosper today doing was it a walkthrough, final walkthrough?
Had an inspection and start trail, and then I went over and visited a home being built for another client.
Okay. So. I love Salina. However, I can't justify the PID mud. You are so right, Isaac. They are just so PID heavy there. They love their PIDs. And McKinney didn't used to be that way, but all of their recent affordable ones all have PIDs.
Because they're just northeast, which is out of the city limits, and they don't have the infrastructure there. So
yeah, I was talking to a new buyer, I guess it was earlier this week. And she said she's come from California. She goes, California's not like this. It's like the property taxes are a specific rate. You don't have all this PID and mud, and Texas is just so confusing. And it is like because like, and it was interesting. She's very interesting how she gave perspective on that, because if you think about it, it changes by the neighborhood, because you have your county taxes, your city taxes, you have your school district, you have your college, sometimes you have your hospital. All of these are property taxes.
Depends on if you're in or out of city limits and what their infrastructure is like. So
it really is. Texas is so ambiguous in that way. PID is killer for home shopping. It sure is. It is. You got to know it. Yeah. And then also, the other thing we were talking about was like how Texas is a non-disclosure state. And so you can't even see sales prices. So there's just all this obscurity that requires so much more research. You don't know what homes have sold for. You're not going to have that data because it's a non-disclosure state. And then you've got to figure out, the county taxes, city taxes, the school taxes, and they're all different. Sometimes it's Denton County with Prosper ISD.
The information is there. You have to look for it on the county websites. It's there. It's actually there. It gives you the rates. It gives you what the tax entities are. They're there. You can look up homes that are in the neighborhood that have sold before. You've been there. They have improvements already with the county, and you can see what their tax entities are and what their rates are. So you can do the math and figure it out. So it's there. It's just, you do have to look though. Yeah. And almost every county has what you call a tax estimator when you're wanting to know that as well. But the tax estimator doesn't tell you anything about a PID. Well, that's why and all the PIDs are usually on the city website. So because PIDs are city based. It's the city's selling bonds to that's basically they're doing a loan to pay for infrastructure. So, but if you are moving here from out of state, I can tell you right now, there's a lot that you're going to have to research that is not as transparent. You can't see the sales prices, and you have to look in multiple places. No more fun state than Texas. What do you think? There you go. Dallas-Fort Worth makes it even more fun. And then it's just, there's just a lot that you've got to research. Make sure that you don't get the numbers wrong, because you've got your PIDs, your meds, you've even got MMDs. You have all of these different things that can layer on. But that's why we're here. That is an excellent point. That is exactly why we're here. We can tell you right off the bat. We're here to help, but we are not from the government. It's like, heaven forbid. Oh, thanks to, there we go, Purple Drawing. Thanks to Wendy and Dale. I have done a lot of research. Good. Because that's exactly what we really push is do the research, do your homework, never make an impulsive decision. Always, get representation for somebody who's going to do that for you as well. All right. Well, what do you think? Shall we call it a night? I guess so. I think so. Well, everybody, it has been outside. Great. Well, it's dark by 6 o'clock now. That doesn't make any difference.
It's been good talking to you guys tonight, and we will not see you next week. We're going to go ahead and take off the week for Thanksgiving. Yeah, it's Thanksgiving. We're going to have some family time. So we will see you 2 Tuesdays from now.
Well, happy Turkey Day then.
Yes,
too, so.
yes. Happy Turkey Day to you guys next week, and we'll talk to you the week after. All right. Bye, you guys. Bye.